sounds like some old folk rock song from the 70s. Missing Melissa. Yes. And still I'm missing Melissa.
Rockabilly.
Right. Do you ever know? Oh, right.
Pass the mic to you first.
Yeah.
Yeah, I think you do a great job.
That'll work.
Noted here none of the microphones worked consistently. Fading, not one touching.
Hello, everybody. My name is Mitch Miller. I'm a consultant at the Beister Institute at the Rady School of Management here in La Jolla, at UCSD in La Jolla. I'm speaking today at the Beister Symposium, which is a conference of the Institute of the Study of Employee Ownership and Profit Sharing of Rutgers University at the School of Management and Labor Relations. The theme of this panel is how do ESOPs and worker cooperatives actually work? The context for research. We have three panelists today. Martin Staubis is the Executive Director of the Beister Institute and an MBA program instructor at University of California, San Diego at the Rady School of Management. He's a former policy analyst and staff attorney for the U.S. Department of Labor and a really good guy to know. We also have Melissa Hoover, the executive fellow an executive fellow at Rutgers School of Management and Labor Relations. She is a founding executive director of the Democracy at Work Institute and a longtime co-op developer. And Camille Kerr is also an executive fellow at the Rutgers School of Management and Labor Relations. She's associate director at the ICA Group. She's an attorney, and she's associated with the Council of Cooperative Economists. So without further ado, I'd like to pass the mic to Martin for an explanation on ESOPs.
All right, thanks, Mitch. Yeah, I think what we'll do here is I'll talk for a little while to give some basic background on exactly what ESOPs are and how they work, and then I think Melissa will talk for a while about worker co-ops, how they work, and then I think Camille will sort of lead a discussion of a bit of comparing, contrasting, getting into some of the nuances and subtleties of differences, remembering that after all, at the end of the day, they're really just variations on the same theme, which is putting the ownership of the company in the hands of the people who work there. So this ESOP idea, you hear a lot about this in the conference. I love this conference because it's so fascinating to get people from so many different disciplines. I spend a lot of my time in a business school where a lot of basic information about business is assumed, but we have people from disciplines like sociology, psychology, other fields where we won't assume so much background. So the ESOP idea, of course, first thing, it stands for Employee Stock Ownership Plan. And I think an important thing to recognize about it, the ESOP is that at its core it exists as what's called a qualified retirement plan. So that's something that's provided for in the federal tax code. They call it a qualified plan because it qualifies for some certain advantageous tax treatments. And the basic government policy for many decades now has been that we recognize Social Security is not going to really support people all by itself. We want to encourage companies to have or to offer retirement plans to their employees, so they'll have something besides the Social Security. And we're not going to pass legislation forcing companies to offer retirement plans, but we're going to offer inducements. So the tax code provides some very attractive tax benefits if companies agree to offer these qualified plans. The background on ESOPs and how it came to be one of these qualified plans is that you've heard some discussion earlier today about Louis Kelso as an individual San Francisco-based investment banking attorney back in the 1950s and 60s who conceived of the idea. He was, after championing the idea for a better part of a decade, he was finally introduced in 1974 to the chairman of the Senate Finance Committee. At that point, it happened to be Senator Russell Long from Louisiana. Has a very colorful political history. His father was Huey Long, the Kingfish. The way American politics works, I think Corey could tell you much more about it than I do since his doctorate in political science, but the general idea is that whoever sits in the chair of the Senate Finance Committee is the most powerful person in America when it comes to writing our tax laws, because all tax laws go through that committee, and the chairmen run their committees kind of like czars. So the chairman was Russell Long. He got introduced to Louis Kelso. Louis Kelso explained this idea that employees would systematically have the opportunity to earn capital ownership as they worked at companies. Russell said, that's great, I love it, this is the kind of thing I've always wanted to champion. It just happens that there's a major pension reform bill going through Congress, something that's going to be known as the Employee Retirement Income Security Act, known by its initials in the acronym ERISA. So this is the ERISA legislation. And he says, I'm going to insert an extra chapter in that legislation to provide for this employee stock ownership plan as a form of qualified retirement plan. So that's how it came to be. It means it's been part of the law since 1975. And it's fueled by some very impressive tax benefits, which have actually been enhanced since the original legislation. Corey had a role in the staff of adding some additional tax benefits to it. So at its core, it's simply a qualified retirement plan, but it's actually a great deal more than that. It really acts as a mechanism by which the owners of existing companies can sell their ownership to the employees of the company. And a key point here is people hear that and they say, gee, that's pretty tough for the employees to raise the money to buy the company. The point is that employees don't pay anything for the stock. This is essentially structured as a leveraged transaction, meaning that it's financed with debt. So the ESOP as a plan, another technical piece to it is that all qualified retirement plans must be structured as trusts. So an ESOP is a kind of trust. There's a trustee that heads it. The trust borrows money in order to purchase the stock. So that's what we call a leveraged transaction. This is really the same financial structure that people like Carl Icahn and the other sort of notorious corporate raiders would use. Carl Icahn would say that a good business person will buy something for a low price and sell it for a higher price. But he'd said, me, I'm not a good business person. I'm a great business person. I'm not going to pay a low price for what I'm going to buy. I'm not going to pay anything at all. I'm going to buy a company without paying anything for it. How are you going to do that? It's, well, I mean, I'll pay for it in a sense, but I'm not going to use any of my own money to pay for it. I'm going to get it for free as far as me not paying for it. Well, how are you going to do that? Well, I'm going to borrow the money. I'm going to go down the street to my buddy Michael Milken, the king of junk bonds, and say, hey, Mikey, baby, fix me up with about $1 billion worth of revenue from junk bonds, because I got this company in mind. I think I can get it for $1 million, and it's got fat, lazy management. It's not being run very well. I'll buy this company for $1 billion with the money I get from the junk bonds, and then I'll tighten up the company, make it more efficient, shed costs, which is, of course, always code word for laying off a lot of people, and save all that payroll. Profits will go up, and I'll pay back the bonds out of the profits of the company. And eventually, when the dust settles, I'll own this company free and clear, paid off the debt, and never paid anything for the company. And then eventually, of course, I'll flip it, sell the company, and pocket all the money. So an ESOP uses that same mechanism on behalf of the employees. The trust is going to borrow the money, and once it owns the company itself is going to pay back the debt, subsidized by these very impressive tax benefits. So if you want to distill it to a bottom line, the purchase price is not paid for by the employees, it's paid for by a combination of substantial tax subsidies and the future profits of the company that are used to pay back the debt. So one of the important things and takeaways in terms of nuances and difference between ESOPs and cooperatives is that ESOPs are universally established in already existing companies. So a company will have taken form in some other way, typically an entrepreneurially founded company, and at some point in the history of that company, the existing owners will make a decision to sell to the ESOP, whereas cooperatives can, not always are, but sometimes are started from scratch. You'll never have an ESOP company start from scratch. So it's a significant difference. One of the tax benefits that makes an ESOP kind of almost a prohibitive favorite for very large companies is that the tax laws have ended up providing sort of indirectly, I'm not sure how much Congress ever quite realized what they were doing because it didn't spell it out in so many words, but the tax code effectively provides that a 100% ESOP-owned company gets to operate as a tax-exempt business. And people are kind of floored by this idea. It's kind of a mind-blowing idea that a company can exist, and it's not a charity, it's not a 501c3. This is a for-profit business which simply is allowed to operate without paying any taxes on its profits, which is unique to that. And it's just pretty unique in the American tax code. Cooperatives don't benefit from that arrangement. So it means the company can make as much profit as it's able to make, keep all that profit, not pay any taxes on it, and have that money available to reinvest in the continuing growth of the company. It does that, the details, if you're interested in slightly arcane points of tax law. The company would operate as an S corporation. There are really two options for any corporation. You can either pay taxes as provided for under subchapter S of the tax code or under subchapter C. And so as a C corporation, as they call it, pays its own taxes on its profits. An S corporation is treated as what's called a pass-through entity, meaning that whatever profits it makes are considered to be the direct personal income of the owners. They have to pay the taxes on those profits. Anybody who owns an interest in an S corporation and is suddenly responsible for a big tax bill because the company's profits will expect to get a distribution of money out of the company to cover that tax bill. So money leaves the company to cover taxes even though the company isn't personally writing the check or at the corporate level. So if you have a company that operates as an S corporation and pays no taxes at that corporate level, and the only legal shareholder is the ESOP trust, which is a tax-exempt plan, which is a qualified plan, which is tax-exempt under the law, then the shareholder does not have to pay taxes. So there's nobody left for the IRS to tax. Neither the company nor the owners pay the taxes. So it's an almost prohibitive advantage to operate with that amount of extra cash flow you earn. So that's the basic structure of an ESOP, a qualified plan. At its core, used for existing companies to carry out a leveraged buyout where stock is bought for the employees, held in trust accounts for them. That'll be structured, it'll look structurally a great deal like a 401k plan in the sense that each employee has their own individual account and that account simply holds shares of company stock for them and it's held for them until they leave the company. The last point I'll cover before I give Melissa a chance is that I've covered pretty much how they come to be and the basics of their financial structure. Once they're established, the question is how do they operate? They don't change the fact that the underlying business is a corporation. And under corporate law, all corporations are required to have a board of directors that has the authority to make the largest decisions. They have ultimate power in the company. The board of directors, of course, where do they come from? Are they found under mushrooms or what? The board of directors is elected by the shareholders. For an ESOP, you get into this complicated situation where technically the shareholder is the trustee of the ESOP. That's what trusts do by definition. The sole reason that a trust exists, its sole function under the law, the sole function of a trust is to separate the financial benefit of ownership from the control of the assets in the trust. You see them used where parents leave, money for minor children, give it to a trustee. You get to control the money, decide how to invest it, decide whether you're going to give it to the kids to pay for their college, whatever. But ultimately, you're supposed to be managing the money for the benefit of the kids. So a trust is the same structure. So the question is, to what degree do employees have control over the company that they own? And the answer is that the ESOP makes that degree of control elective, according to how the ESOP is set up. So the stock will be technically owned by the trustee. The plan can be drawn up, and ESOPs are required to be written out in written form, so they spell out a set of rules how they operate. And the rules can provide that the trustee retains that voting authority, or can provide that the voting authority would what they call pass through to all the participating employees who really decide how their shares should be voted. So it's sort of optional. The last point on that I'll make is that companies really aren't run on the basis of shareholder votes. If you look at corporations anywhere, they're not, sort of managing the company based on conducting shareholder votes by definition, or it's not so much by definition, but by the very concept of corporations. They're a creature of the Industrial Revolution, where they came about as a mechanism for pooling investment cash from lots of investors who might be distributed far and wide and aren't in a position to monitor the company. So they hold the voting rights, but they're not really running the company. Their sole desires of these investors classically is to get a good board of directors elected who are going to look out for them and let the board be the ones who really set the big policies and oversee the management of the company. So shareholder voting is really almost sort of a non-issue in terms of running the companies. That's not how decisions are made. A typical company may go years and years and not have a shareholder vote on anything other than, in most states, they annually require a vote to re-elect the board of directors. So that's the governance piece of ESOPs. It's how democratic they are is optional. Camille and I worked jointly on a project where we created an ESOP that featured full democratic cooperative style governance because that company chose to have their ESOP set up that way. That's the piece on ESOPs. Melissa.
Great. So I have a PowerPoint. I want to invite you guys to move closer if you want to be able to see it. And then Camille has a even more detailed PowerPoint.
She showed on her phone.
You'll want to be in a closer where you can read it. Plus, it's a little odd to be like shouting to the back of the room. But so I'm going to go ahead and guide you through worker co-ops. Yes. So my challenge from Joseph was worker co-ops. How do they actually work? I'm going to add the clicker here. Let's see. Great. So the first thing to know about worker co-ops is there is no single worker co-op. There's a plurality of forms. This is part of our challenge. So there are cooperative corporations in which the members are employees. That's probably the most standard. There are increasingly LLCs, worker co-ops formed using the LLC. I'm working on one right now that's an employee trust. It's a corporation with an employee trust sort of wrapped around it. And then there are miscellaneous other forms, C Corps that function as worker co-ops, any number of state-based forms. So this is our challenge. We've seen LLCs growing a lot. Like that is the growing edge of worker co-ops, which presents, I think, some unique challenges. I'm going to focus on the cooperative corporation for our purposes today, just so we can sort of get the standard format down. And I think it's important to know the other forms kind of mimic the cooperative corporation. So if we don't have a standard national legal format, it can be comforting to know that there is an international kind of set of principles that co-ops adhere to. It's meant to be a perpetual form, so to live beyond its founders or the group of people who are currently members in the cooperative business. These are some of its principles, but not all. So it's a membership-based form. It's meant to benefit and be run by its members. So members have democratic control through a one worker, one vote mechanism. Members are the shareholders in the co-op. They economically participate by owning a share, and then they receive a dividend on that share. And then the education commitment of co-ops, I think, is really important. It goes back to the perpetual institution idea. Members have to be constantly replenished and ready to take over their ownership duties. So it's, this is what's guiding co-ops sort of more generally, and it's legally codified to some extent in the US. I think, co-ops come out of market gaps. So places where either the market or the government or both are not meeting communities' needs. They form cooperatives to meet those needs, to do some kind of economic activity. So cooperatives are much larger than worker co-ops, right? There are producer co-ops of farmers who come together to sell together, consumer co-ops, people who come together to buy together. A worker co-op is another co-op where people are coming together. Essentially, they sell their labor to the co-op. So that's sort of the structure in which to think of it. Worker co-ops are by far the smallest sector across the world, but they are tucked into this larger cooperative movement. We have a working definition of a worker co-op. I'm not going to read it or ask you to read it. I just share it here so that you know that there is one available. Camille actually was instrumental in drafting this. We were trying to create something that could bridge all of those corporate forms, that adhered to principles, that articulated For us, a standard that could be used nationally to say that is a worker co-op or isn't a worker co-op. And that's an expansive impulse rather than a policing impulse. We're not at this point in our evolution worried about abuses of the form. We're more, the bigger danger is that people won't innovate and expand it. So with things like employee trusts and LLCs and all kinds of new forms being created, we wanted to be able to capture those and say what did and didn't belong, but sort of to create new room and new places for growth in the worker co-op world. So if we go back to that cooperative corporation, sort of the national governing regulation is the tax code. So subchapter T of the IRS code allows that any corporation operating on a cooperative basis can deduct from their gross taxable income the amount they pay in patronage refunds. So this is sort of based on the consumer model where we're all in a cooperative, we're all patrons of that cooperative. If at the end of the year the co-op shows a profit, it's because we paid too much as customers. We paid above a break-even price, and so we get a dividend, a refund back based on our patronage of the co-op. And it's a really common mechanism, and the intention is to create some surplus. You don't just want to be totally breaking even as a co-op, but then the secondary intention is to distribute that back out to the members, who are the people that the corporation is intended to benefit. So in a worker co-op, what this looks like is you make a wage. The co-op conducts its business at the end of the year as an owner of the co-op. If there is a profit, that's distributed back to you as the person who sold your labor to the co-op effectively. So in a co-op, it's fairly simple ownership structure. So there's member equity, which is your initial investment in the co-op. Tends to be well, it doesn't tend to be anything. It's all over the map, actually. It's everywhere from like $10 to $10,000. And at $30,000, okay, wow. So that's, it's based on the industry, on the capital needs of the co-op, on the ability of the members to pay, all of those kinds of things. So you have your member equity, that sits there. It doesn't appreciate in value, so really different than an ESOP. It's not revalued every year. That share value doesn't grow. It doesn't earn interest. You simply are paid it back out. The co-op buys it back from you when you leave. The other part of your member capital account is what's called retained patronage. So that's that dividend every year that gets put on your member capital account. That can, I had a cool animation that showed it growing and then shrinking based on the profits every year. But I think it's sort of important distinction between ESOPs. So the value that you receive as an ESOP participant is really realized at the end of your career, if I understand it correctly, right? So you have this share that grows and grows, and then by when you retire, you've got a little nest egg. In a co-op, you have your initial investment, and then every year, as the co-op is profitable, you take a little bit out, and a little bit gets put on your member account. But it's not a share that keeps growing in value. So patronage. I think I already explained this, but just to sort of bring it home. So as a member of a worker co-op, you're an employee in the corporate model. So you get paid a wage. It's guaranteed. That's what employees get under labor law as a worker in the co-op. But then at the end of the year, if there's surplus left, it's distributed to you as an owner. Not guaranteed. Can vary in amount and is really based on the performance of the business, not on how many, not on you showing up at work every day, but how well the business is doing. And so that patronage distribution happens in two ways. Part is paid in cash, and part is retained on your member capital account. 20% minimum is due to you in cash so that you can pay your taxes on it. So that's a sort of technical part of it. On the ground in 2018, I think it's really important to understand what's going on in the worker co-op world. So there's been a sea change in who's using worker co-ops and why. In the 70s, we saw this sort of countercultural surge of people with options wanting to create an alternative option and sort of exit the economy. And starting in the 90s, we're really seeing people using worker co-ops People without options, people who are locked out of good jobs, locked out of business ownership, don't have a way to transition, nobody to sell their business to, using worker co-ops as a way to enter the economy, but on their own terms. And so these are typically low-wage workers, communities of color, women, and we can look at the data and see like 70% of worker co-op members who have, new since the year 2000 are people of color, 60+% are women. There's massive growth in the service sector and low-wage work industries. So that means, there are very specific things that implies about how we support co-ops and about where they're growing and scaling. The future of work looks incredibly contingent. There are going to be all new forms of the way labor is organized. It's entirely possible that the employment relationship is severely diminished, if not eliminated, in the way that we're organizing work. Unions are losing power. Contingency is growing, and so co-ops, worker co-ops in particular, if we go back to the idea that they meet market gaps, they meet people's needs, are being used by people who are in contingent situations to stabilize those as a sort of a different way of organizing their labor. So there are some experiments with scale happening right now, and I think that's one of the reasons Joseph wanted us to sort of disambiguate the forms, but also recognize how they are linked and the sort of the spectrum along which they exist. So we're seeing platforms, some of the work Camille's been doing on platform co-ops and workers, gig economy workers, contingent workers, service sector workers, creating platforms, both technological and frankly not technological, just sort of purchasing co-ops or other kinds of ways to come together to aggregate resources. Third-party labor, increasingly as major corporations are not employing their own workforce, but using third-party contractors to source those employees. We're asking the question, can those third-party contractors be owned by the people who work for them, to sort of break that chain of, losing accountability at each stage. So actually creating a worker-owned third-party contractor that then negotiates with the entity that's been outsourcing labor. And then there are some experiments with a leveraged buyout or private equity model to meet the capital needs for these growing scale experiments. We're looking at much, much larger co-ops forming and the conversion of large existing businesses to worker ownership, and there are some unique capital needs there. So this question of outside investment, typically co-ops have been capitalized by their members. It's a pretty straightforward form. Again, with the scale pressures and the communities that are coming into worker co-ops are not bringing a lot of capital. So how do we meet that? We're not going to do it on philanthropic funding. We need actual investment capital. So co-ops typically have member shares, but they also increasingly have been selling preferred shares to outside investors, which return a limited dividend. It's modest, and they don't have control rights typically. But it's a way for investors to support the co-op and to get a little bit of a return. But increasingly, we're seeing other mechanisms for outside investment. And I actually don't think in some states, there's a legal prohibition against outside investment for co-ops. But in other states, we've changed those laws. There is a pretty vigorous debate in the co-op community about whether and how to accept outside investment, because if the premise is that the shareholders own the business and the shareholders are the members, are the workers, it's a little controversial to open it up to other shareholders, figure out what their rights are. So that's a sort of a live conversation for us, but I don't think it's a legal question as much as it's a question of will and creativity to understand how we can adhere to those founding principles, but still raise the kind of capital we need to meet the demands for worker co-ops right now. Let's see. How am I doing on time? Nope. I'm going to take you through this really quickly. If you want to see it later, we'll do it. But this is a demonstration of patronage distributions. So, income minus expenses is the net income. Profit is the part generated by non-members in the co-op. The surplus is the part generated by members. And then that surplus gets distributed. This is where it gets a little crazy. Goes into a collective account and then goes out to the members as a patronage dividend, and then part of it in cash and part of it retained. and then each member gets their portion. So this is just the sort of the financial mechanism. It's totally in the wrong place in the slide deck, and I think I decided not to do it, but there you go. So what do co-ops' financial statements look like? Well, they're a little bit different. So the equity section shows those member capital accounts. These up there in the blue, that's the retained patronage that is held onto for some amount of time and then paid out later. So those are going to show up by name on the balance sheet, showing shareholder membership, ownership. The retained earnings of a co-op are generally lower than comparable business in its industry, and that's not because they're making less money, it's because they're distributing those profits out to members. And when they're distributing those profits out to members, the co-op is not paying taxes on that income. So before income tax is calculated, that was the sort of the, when I teach this, that's the whole point of the splitting off the surplus from the profit, is that surplus, which is distributed to members, is not taxed at the corporate level. And then often the equity section will show some kind of subordinated outside investment. So the preferred shares or another form of outside investment. And then I think it's important to remember that there's an implicit relationship between labor costs and patronage. So the higher the wage, the lower the patronage, vice versa. So when you look at member compensation in a worker co-op, you're looking at both their wages and benefits and their patronage distributions at the end of the year. I'll leave it there, and I'm going to say that there are a couple other thoughts. I didn't cover governance in this at all, and I think there's any number of ways that co-ops are governed, but typically they have a board of directors. Members, at the very least, have the right to vote for the board of directors and to serve on the board of directors. The board is elected by the shareholders, who are the member employees. And then some co-ops have outside directors, some don't. In some co-ops, the board plays a really important strategic role. In others, it's a symbolic function. It's really all over the map, and that's a reflection of sort of the way we're all over the map by size and industry and age. And similarly for management. I think there's a misconception that worker co-ops are all collectives that are run by consensus, and I really want to dash that one against the rocks of reality. It's not true, and it really isn't true for the larger co-ops. It is true that worker co-ops tend to underinvest in management and to not grow as aggressively because of that underinvestment, which is something we're attempting to remedy through our School for Democratic Management. So getting co-ops some support for management is sort of, we think, one of the key drivers for growth. Co-ops will always start up. There will always be startup co-ops, always sort of do it yourself and then assisted do it yourself, but we don't think the scale drivers right now for co-ops lie in startups. So we're looking at the conversion of existing businesses as a way to sort of kickstart the growth of work, not the growth, sort of continue the growth, but kickstart scaled initiatives for worker co-ops, connect more to the ESOP community and the ecosystem of support that there is for implementing employee ownership in existing businesses. And then there are, I think, some expansive notions of what co-ops are that aren't just a corporation owned by its employees, but may look something more like a purchasing co-op of contingent workers using a platform to organize their labor. So Camille's going to talk, I think, a little bit more about that spectrum and the different forms that worker co-ops take vis-a-vis ESOPs.
Great, thanks. So I'm going to be walking you through 3 tables that kind of just compare the different standard forms that we're talking about here, ESOPs, cooperatives, and I put the employee ownership trusts in there because there's a growing interest in that form. And I'm going to start by talking about the differences in a conversion transaction, and then go to financial considerations and then governance considerations. So I'm going to wait for a second for that to pop up. So it is a little dense, my apologies. So comparing the transaction structure, so the way that I structured this is really to look at topics like access to financing, whether you can use leverage, the tax implications, and then look at these 3 structures, and feel free to push back on anything that I wrote up there. It it's not the most vetted presentation that I've ever done, but I do want to just walk through and say, like, okay, when it comes to leverage, all three forms can access capital and debt leverage in order to transition a business to worker ownership. ESOPs can leverage, and they can also get tax benefits from writing off those payments. They also can access that leverage usually without any buy-in from workers at all. So those two things differentiate it, but certainly all three forms have the ability to use debt financing to do a leveraged buyout. That is not something that's just unique to ESOPs, and I think that's a little bit of a misconception, so we wanted to clarify that. I think there is access to financing across the board, although there are gaps in that. We see some companies not transition because of access to capital. So there are different actors that are trying to fill those gaps, like some larger scale transactions where the sellers don't want to do a lot of seller financing. There's an equity gap or a mezz capital gap in worker co-ops. Sometimes you don't have a personal guarantee and you need one, so there's a gap there. So there are some gaps in the financing across the board, but there are people who are innovating along those lines to try to figure out how do we fill those gaps. On taxation, you might have heard earlier Corey talking about Section 1042. It allows selling owners to defer their taxation on the gain from selling their business. It's something that is primarily used by ESOPs. It technically, under a provision that's called EWOC, eligible worker-owned cooperatives, can be used for cooperatives, worker co-ops too, but to date, has anybody actually, did Island Employee do it?
Two.
So a couple have explored it and used it, but it's not nearly as common as in the ESOP space, where I think just under half of ESOPs currently use it. And employee ownership trusts, you'll see across the board, are pretty not tax efficient, but we'll see on the governance side are incredibly flexible on governance, so that's why there's interest in creating them. So in selling price for the transaction, in ESOPs you have to do financial buyer value. You can't do strategic buyer. You can get the owners to get some of the upside through warrants and other structures, but generally it has to be a market value and by a third-party valuation. There's no regulation on either co-ops or employee ownership trusts, but that doesn't mean that you can get strategic value. Most of these are done based on market value or below. A lot of people take a hit on both of those structures in order to transition their business because of the amount of leverage they're putting on the company and the financial burden that they're putting on the company. Going much above market really doesn't work. And then when it comes to buy-in, there's generally no buy-in for an ESOP. In some cases, they will use the 401k funds to partially finance the purchase. I don't know a lot about that transaction mechanism. How common is that?
Quite uncommon, like 2% of the time.
Yeah, about 2, but it's something that can happen. So it's kind of like a buy-in. It's using worker money to finance the transition, and the workers have to directly approve that. But usually there's certainly zero cash. I don't think there's ever been a transaction where people put cash down. Whereas with cooperatives, you generally do have some kind of buy-in, even if it's nominal, especially if you're going to use subchapter T, because that's one of the mechanisms by which they look at you being an owner is whether you bought that share. So there's usually at least 25 or some kind of nominal buy-in. And some of the co-op developers talk about used car something that's financially significant but not overly burdensome as the amount of buy-in. And for the employee ownership trust, it's hard to say generally because they're so new and like we're kind of everybody's making it up as they go along. But one of the ideas behind it is that it mirrors what an ESOP looks like, but both doesn't have the tax benefits and doesn't have the regulations involved. So if you're looking at them that way, then you also wouldn't do a buy-in. It would just be just fully leveraged, which means there's capital access issues involved with that. So other financial considerations are just tax savings for company. That's a little green dot, but for large companies that are very profitable, that's a very big green dot that overwhelms everything else, as you can save hundreds of thousands, if not millions of dollars on your taxes year over year. So that's why when we're looking at bigger companies, it's really hard, unless there's a very compelling reason not to use an ESOP, that's going to be the best choice, because it's just so tax efficient. The co-ops are somewhat tax efficient, and I've been seeing like rumor articles, I haven't read into it, that some of the new tax regulations actually create other tax benefits for cooperatives, but also some might be pushing away. But they're like tax efficient in the way that an S corp, like not having double taxation, is tax efficient, not in the same way that an S corp, which basically gets the same, as Martin was saying, same treatment as a charitable nonprofit gets. So that's different. And employee ownership trusts aren't tax efficient at all, but but we'll see again in governance why people are interested in them. So the financial benefit to employees, the differences across the board here. One is really what Melissa and Martin mentioned, is that the market value of the shares is a major difference. Like, you're not getting that multiple in a co-op the way that you are in an ESOP, and that's both good and bad. So I put it all gray because there's like kind of differences of opinion. Some people say, like, if you're not getting that financial benefit of the multiple, like I think Corey feels this way, then you're really not benefiting employees and helping them build wealth. On the other hand, every time somebody leaves, you're selling the future profitability of that, you're giving the future profitability to that leaving owner, to that leaving employee. That's difficult for the future employees. So which one is better for employees is kind of an open question that I feel like, it depends on your perspective. So you often get dividends, and you get annual dividends in a cooperative. And an employee ownership trust, it probably is going to be bonuses or something like that, not actual dividends, because they're not allocated to people directly. One interesting area is the buyback financial burden. So, this is employees who own stock. What happens when they leave? What's the financial burden look like? In ESOPs, that can be really burdensome because it's market-based. If your company got really profitable and people left in the year that it got really profitable, and you're paying that multiple out, that can be a difficult financial burden. But there's also, because it's such a robust service provider community in the ESOP space, I think, is it Judy's organization? What do they call it? ESOP Economics, and other organizations that are dedicated to figuring out repurchase obligation and making it so that you plan ahead for it. So ESOPs manage it, and for some companies it's been a real burden, but ESOPs tend to manage it well, but it can be difficult. Because co-ops are not market-based, it's certainly predictable how much you're going to have to pay out when people leave, which is a little bit easier. And there's no distribution regulation there is around ESOPs, so you can basically write in your distribution policy, like, if we don't have money to pay you, we're not going to pay you, and it's going to be fine, I think. And employee ownership trust, one of the interesting mechanisms, thing about that mechanism is there is no buyback whatsoever. It's just annual dividends. There's no buy-in. It's just it's owned for your benefit as workers, and there's no ownership that's allocated to you either through a trust or directly. So it's just a trust for your benefit. So you get those profit shares, but nothing happens when you come in and go. That trust just stays the same and stays representing the people who are in there. And the cost of transaction, I don't know if these numbers are accurate, but I think somewhere in ESOPs or somewhere, last time that I had to look into it deeply, it was like somewhere on the low end from $60,000 to on the high end $400,000. Does that sound right to you, Martin?
Yeah, very high end, yeah.
So for fancy warrants, large company type boutique law firm transactions on the high end there. And co-ops, I know that it can be subsidized lower than this, but I don't think anybody's doing the work for lower than this. It's $25,000 to $75,000. And I don't know about employee ownership trusts. We structure ours. It looks about the same as the co-op pricing, but I don't know the other examples if it's similar. And then the ongoing cost of administration. This is another place where I'm just going to look to Martin and see, is this right? But you have to do an evaluation, you have a trustee, you have other costs. It can be as low as 10 maybe? Yeah. It can be as low as 10, 30 is a little bit on the high end there, and it can get higher depending on how, how active, those repurchase obligation or other services that you purchase. I think for cooperatives, mostly the ongoing cost is an investment in ownership culture, but have you seen other ongoing costs?
Well, you have to pay a co-op accountant to calculate your patronage every year, but that's
Right.
basically part of your tax filing. So.
Right, so above and beyond being a corporation, there's not much distinct, but possibly taxation, dealing with your taxes. And then employee ownership trusts, we would assume there'd be trustee fees as well as the things that the co-ops pay for as well, but I'm not sure what those are going to pan out to be, because I think people are doing it on kind of we care about this pro bono basis right now, and we'll see when it professionalizes what those costs look like. Oh, nope. And then governance and culture. So staying private and employee owned is kind of one of the interesting, is one of the areas where like one of our clients was like, we really never want to be bought, and we're in an industry where people go and actively try to buy companies, and so they thought, well, that's one of the areas where we think an ESOP has some vulnerability, because a trustee has the fiduciary obligation to participants to I don't know about maximize, but in their financial interest is, and in their retirement interest. But it's so rare that a company gets bought out from under its, like if you're looking at ESOP and co-op and you're like, oh, that's the marker that we want to prevent, unless there's a really compelling reason that you think somebody's going to try to use that mechanism, it really doesn't happen to companies very often. They don't even get pressured into it that often, right? Yeah. In a co-op, it's designed so, but the other side I have here is that I do think I've seen some examples of management being able to slowly dissolve an ESOP if they want to. So even though an outside buyer can't really undermine the employee ownership, your management team might be able to undermine employee ownership over time if they're not bought into it. Whereas in a cooperative, really the members have the ultimate say on whether they stay a co-op or not, and whether they stay democratic. So an employee ownership trust, nobody has that decision. It's like a document that says we have to be employee owned forever and ever and ever, and nobody can change it ever. So it's not the members, it's not the management, nobody can change it. That's one of the appealing things for people on that idea, is that it's perpetual employee ownership documented in a trust structure. And then democratic control by tenured employees is possible with an ESOP, almost very close to what we can achieve with a co-op, and Martin and I can talk to you more about how we did that recently, and there have been other organizations who've done that as well, just a handful of examples of that fully democratic ESOP. And then employee ownership trusts, they're using a mechanism that you can say whatever you want in the trust, and you have to adhere to that, so it can require that workers appoint the board on a one-person, one-vote basis, or that the trust is just held on the benefit for employees and they don't have any vote. You can really be flexible with that mechanism. And I think across the board, building a strong ownership culture is a really major benefit of employee ownership in general, because instead of just saying like you should act like an owner, you actually are one, you have that financial stake. The only caveat I would give that if it's an ESOP, like I don't think a 10% like plan where people aren't communicated well about it really is going to generate that same. It has to have a meaningful financial stake. It has to be a meaningful level of ownership for you to be able to have an ownership culture to build off that foundation. So that's all I was going to say, and I think we have time for, yeah.
I had a thought.
Yeah.
Is that okay? So I think it's really important to be conversant in this whole spectrum. like if we're going to have a strong employee-owned economy, it needs to meet the needs of people at all wage levels and at all resource levels. And I think co-ops, as it's shaking out, are really increasingly being used as a tool to stabilize and raise the quality of bad jobs, which are growing in our economy, and as a form for low-wage workers to have a greater degree of control over their workplace and realize some of the profits. The bigger co-ops and more profitable industries are also wealth-building vehicles, but they tend to be operating at the lower size end of the spectrum and the lower wage end of the spectrum, not exclusively. You can use co-ops to do anything, but that's where we're seeing growth. And then on the ESOP side, increasingly we're seeing research about low-wage workers in ESOPs, but they have tended to be larger businesses, a certain level of profitability. So I don't think it's an either or. In fact, I think not even is that just a false binary on like ideological grounds, it's just practically false. Like they have very different uses. And so if we're conversant across the spectrum, we're set up, I think we're well positioned to build a strong economy. The other thing I would say about this sort of ideology question, the co-op principles can be seen and implemented as ideological, but they were actually expressly written to be non-ideological or to be ideologically ambidextrous. And in places where we've seen co-ops scale, they aren't really a sort of a fetishized object. They're just an everyday kind of functional part of the economy. So in places like Emilia-Romagna in Italy, there is a political dimension to them. I mean, it was a leftist government that put in support for co-ops, but at this point, at the scale that they've grown to, they're just sort of like your grocery store or your food manufacturer or the place that makes custom locally manufactured goods. So I think we just don't have an experience of that in the US yet, seeing this sort of like tiny radical thing, co-ops, but in reality, as we scale, we're opening that up quite a bit and seeing people who we don't think of as the usual suspects for doing cooperative ownership or employee ownership really come into the field. So I wanted to just make that distinction because I think it sort of shows up here, but there's also all of this background kind of cultural baggage to this discussion that we haven't really directly tackled yet.
I'll just add a little comment and then we'll turn it over to Mitch. I think Melissa was kind of suggesting that these are all mechanisms at the end of the day for fundamentally delivering the same thing, which is that workers owning the company they work for. So there's just some relative subtleties and nuances in terms of where one structure might fit better than another, advantages and disadvantages and that sort of thing. One brief one I'll just mention is that with the ESOP, it's possible to have a company be partly ESOP owned. You don't have a partly cooperative owned company. It is or it isn't. As I say, ESOPs spring always from a pre-existing company. So the owners of the pre-existing company may decide that we're going to put a third or a quarter or a half or 2/3 of the stock into the ESOP, continue to retain the rest of it. One example probably illustrates a number of things is that the largest ESOP company in the country right now is Publix supermarkets. We don't see them out in the West, but if you're from the East, especially the Southeast, you've seen the Publix supermarkets. Whenever they do customer surveys in the industry of all the different supermarkets, they always get the top reviews compared to any other supermarket chains. And the friendliest employees, cleanest stores. It is the original founding family put a majority of the stock in the ESOP, and I think it's about 2/3 ESOP owned, and the original founding family still owns a third of the company. And they have about 180,000 employees, so it's a huge company and growing like kudzu out of the Southeast takes over the country, which is, can't wait to see them come out West. The other one I want to make is that Lewis Kelso, created this concept of the ESOP. He was a character in many ways, kind of this wonky amateur economic theorist, along with his professional work as an investment banking attorney. And I'm not a person who's inclined to be sort of cultish or whatever, so I don't glorify him too much. But he did, I think, have a real insight, a kind of a prescience, all the way back in the 1950s when he was witnessing what in those days, we used to call automation. I think today we call it robotics. But the idea that more and more work was being done by machines. And he was essentially sort of predicting this trend, whereas more and more of the work was done by machines, Machines, of course, are provided by those who supply the capital. So, and of course, those who provide the inputs to production are entitled to collect the outputs. So if more and more production is accounted for by people who are providing the capital for the machinery and less by the people who show up just to contribute labor, then more and more of the economy is going to go to those who supply the capital, and less will go to labor. And he's predicting as the trend continues, you know, those who just show up to work are going to have this tiny claim on the economy, and all the wealth will go to the rest who are supplying this capital. And what he was really predicting was this 99% 1% divide. So the 1% owns all the capital. They collect this vast majority of all the wealth that's produced. And the other 99% that work get this what's left over. And we continue to see that today. I mean, just, you know, last couple of weeks, the latest in the regular distributions of information from the Labor Department's Bureau of Labor Statistics. They say labor unemployment rate's down to 3.9. It's incredible how low the unemployment rate is. And yet, gee, you know, somehow wage rates just aren't budging. You know, the average hourly wage rate in the last 10 years or something has gone up 13 cents an hour. You know, it's like hardly any wage rate. So, you know, where's all this incredible economic activity that's going on? Where's all that wealth going? It's going to those who supply the capital. What do you know? Just like Louis Kelso said, and the 1% are getting ever richer. So Louis Kelso's idea of the ESOP was intended to break that down so that people who are otherwise ordinary working would automatically have a chance to own some capital, starting with the company they work for. So that's why it was important for the ESOP concept to put actual sort of stock ownership in the employee hands, so that as companies grow and become more valuable, it becomes a long-term investment and they really can accumulate wealth as opposed to more current income. Now, in fact, it's not one or the other. You know, I think a lot of employee-owned companies do include profit sharing. I certainly encourage that. I think it's a lot to ask for a young employee. Just stick with the company. Don't worry. 50 years from now, you'll collect this big paycheck. So we want to have some balance to that. But the core of the ESOP is assuring wealth accumulation. And you do see people, you know, leaving ESOP companies with these amazing checks, these $1 million, 7-figure checks for people who had ordinary, you know, jobs doing nothing all that high level if they stick with the company a long time. So that's kind of the concept. And yet, there's a little bit maybe less difference than meets the eye between that. You say, oh, well, the co-ops are all, there's no, you know, sort of wealth accumulation really. It's more current income of wages and the surplus distribution, you know, of the profits. Well, what's the value? You said this company grew to be very valuable because it was an ESOP company, didn't pay out the money. Well, why did it grow valuable? Its value is based on its profit-generating capacity. So the co-op simply choose to pay out the profits currently. The ESOP-owned corporations tend to reinvest that and accumulate it into a large amount of money later. The one difference, I think, between the two is that ESOPs are much more inclined to reinvest proceeds in growing the company so that you end up with companies the size of public supermarkets, that kind of thing, because of that. So I think they end up being a somewhat better wealth delivery tool to employees who participate. But it's not as though it co-ops workers only get a paycheck. Some people, oh, the co-op, you own your own job, but that's it, you just get your paycheck. Well, you know, you actually do get a share of the profits. But I think, so two things that distinguish the ESOP co-op financially is this long-term wealth accumulation. The companies are really designed to reinvest in growing the company. And that's enhanced by the unfair tax advantages that are structured for the ESOP. They're just so powerful, so massive, those tax advantages, that it really enhances that whole process of reinvesting and growing and developing wealth, as Louis Kelso originally kind of intended. So that's a distinction. Mitch.
Well, thank you, guys. We're at a point in our program where we would like to open up for questions to the audience. We built in about a half an hour now to ask and answer some questions. So maybe you could, if you have a question, raise your hand. I'll reach for you, and then I'll repeat it up in front. So I saw the gentleman all the way in the back raise his hand first. You can just go ahead and say it, and I'll repeat it.
Reason
Thank you for the observation. I think to summarize for those out on the internet, the idea is that co-ops are a little bit disadvantaged at the outset, at the startup phase, especially because future profits will be owned by the current employees of a co-op, as opposed to at the ESOP, where future profits and growth will be distributed more efficiently, even through periods of losses. Did I get that about right? Okay. All right, thanks. How about another question? Yes, the gentleman in the jacket.
Yeah, that one was so good, I forgot to ask my question. This is back on the wealth generation. Your tables were great, thank you. On the wealth generation piece, it seemed like for co-ops, as you mentioned, Martin, it looked to me more like a build-up of book value versus a multiplier effect for an ESOP, for market value. I've got a compound question. Tell me again what the benefits are of that on the co-op side, number one. And number two, it would seem to me that would invite more outside speculation, because you've got an arbitrage situation there where an outside buyer who was trading in market would want to prey on a company that was more value, that was closer to book value. So that could be for anything.
I'll pass it to Melissa. Do you want to repeat the question? Sorry.
No, actually,
I think the question, there was a two-part question, but I think the first part was, as wealth continues to generate, what would be the benefits from the co-op side? So,
Well, yeah, I think the question he's asking is that conventional corporations, including ESOP companies, are valued based on a market value, a multiple of current earnings, one of those approaches that estimates the current market value. Co-ops, you're suggesting, in effect, have nothing but a book value. I think, in fact, co-ops really aren't valued at all, because the value really isn't relevant to anyone. They don't really, nobody's collecting value, but nominally you would maybe track book value. And I guess there's a concern about whether buyers might attempt to buy co-ops, or
I don't know. It seems like it would be far lower.
Yeah, I think, so cooperatives aren't meant to be sold, so that's part of it. So when we're talking about the purchasing, it's while they're still a conventional corporation. We purchase, like when we're doing a conversion of a cooperative, we purchase a conventional corporation and then transition it into this structure that isn't meant to be purchased. And then, and you're right, if we were selling co-ops for market, for like a net asset, value, for like their book value, then that would be not to demutualize and to sell to somebody else. That would be a very bad choice. But most cooperatives are intended never to demutualize, or intended never to be sold. And if they are sold, then they sell at market. They would sell at market, and it would be a joint choice of all of the members, depending on whether the bylaws have another demutualization. Some of them have like a protection that says, like, look, if you sell this, half the value is going to go to the U.S. Federation of Worker Co-ops, because you're not supposed to demutualize these. But some in others, they really feel like the members should be able to choose to do whatever they want with the cooperative, and so they can demutualize if everybody agrees, or if a supermajority agrees. It's usually at least a supermajority on demutualization, but then you would sell at market value.
And I think a lot of co-ops start as a sort of a close to the bone form. So, like, if I'm, if I'm working as an independent contractor, and I want to join together with other independent contractors to create this cooperative, we're not looking at any point to exit. Like, we're not trying to cash out on it, and it's there to meet our needs in the moment, and then it's there to meet the needs of its future members in their moment. But it's a little bit of a different logic to wrap your head around. Ownership doesn't entitle you to sale. Ownership is sort of stewardship, in a way, of this entity that's supporting an economic activity in the moment. And in some cases, particularly with manufacturing co-ops, it's a wealth-building economic activity, but it's not a wealth that any single person or any really any group of members at any point in time is going to be able to realize by selling it. So fair market value doesn't really mean anything for co-ops because there is no market for what they're doing.
And can I comment on Mike's comment too?
Oh, yeah.
So I think that, one thing that's important about what Mike was saying on that there is no incentive to start a worker cooperative, no financial incentive. There's a financial, in fact, he's saying there's a financial disincentive that you will lose money. I am planning to do that. As I start a cooperative, I am planning to lose money in order to do it for ideological purposes. Do we need to create mechanisms and innovate mechanisms and learn from the mechanisms that have already been innovated but maybe not applied to remedy that, so that people who are going to invest a whole lot of sweat equity into a business can get that time and effort paid off in the cooperative realm? Yeah, we need to innovate that. We absolutely need to be thinking about, maybe like what structuring them as like a loan from the entrepreneurs to the company and getting that paid back with interest or whatever it is, whatever we're innovating. We do need to, since we aren't just a conversion mechanism the way that ESOPs are, because startups are important in our space, we need to be innovating on that.
Yeah, I think the two questions that are closely related raise a really interesting point. I'll just briefly comment, and it sort of highlights the fundamental distinction between ESOPs and co-ops, and that is in terms of defining economic success. With an ESOP, pretty clearly and substantially, the economic success is defined by the growth in the value of the company. That's what employees have. They have shares of the ownership, which is pegged to a market value each year, and they have account statements to show here's the current market value of your ownership interest in the company. So people are coming together within the organization to try to grow that value so they can ultimately get a large payout. In cooperatives, it's primarily the current return in the form of wages plus distribution of surplus. That's the only thing that we measure in terms of economic success. And it does create certain pretty obvious incentives in terms of future investment, of long-term investments in future growth. Is that going to make sense in the ESOP space versus the cooperative space?
And co-ops and co-op developers tear their hair about why don't co-ops grow? Well, we kind of know why they don't grow. There's not the same kind of structural incentives. At the same time, in periods of contraction, they tend to survive better. So they're incredibly risk averse. They don't borrow a lot. They don't grow, and so they're set up to survive a little bit better when things take a downturn. It's like a sort of a tortoise in the hare situation, and so I think that's a key differentiator. And well, which is better? Well, which is better for whom and for what purpose? And so it sort of goes back to that. But I think I'm not ready to give up the ghost on can we help co-ops grow? I mean, I think that there are co-ops that grow, and it's about capital investment and policy support. I don't think the structural disincentives in the form are so powerful that they entirely mitigate against growth. I think they're there, and we've seen co-ops grow and scale in lots of other places, and some here.
Marianne, please, yeah. So the question was regarding stock appreciation rights, and what do we see in the market, and especially with regards to the co-ops in terms of the development of SARs?
Well, let me just finish maybe framing the question a little more, and then I'll turn it over to Melissa and Camille. So as Marianne suggested, so stock appreciation rights, or SARs, and everything has an acronym these days, is a kind of artificial stock option. Essentially, employees are awarded SARs, and it entitles them at some point to a payout that's based on how much the stock price has increased, or how much the value of the company has increased. They get a payout at some specified time. These are, as I say, artificial sort of stock options. They're just strictly, really, they're in truth a way of calculating a bonus. The idea is a cash bonus payment, but the size of the cash bonus payment will be based on how much the stock price has increased. So Marianne's really create a question that's maybe handing the solution to Camille and Melissa for cooperatives. Is because it's strictly an artificial creature of contract, there's no reason why a cooperative could not use a stock appreciation rights-like mechanism to provide payouts to employees based on the increasing value of the co-op. So see what they think about that.
Well, since we're not market-based, it doesn't really make sense for us to be doing stock appreciation rights.
But you could, right?
We could. So like any small company, we could absolutely, it would mean valuing the company, which is an expensive thing to do. And so we could value the company, give people stock appreciation rights and still be a non-market-based organization. It kind of goes against some of the principle of like being not market-based, I think. It's like, it could, I have been working with some entrepreneurs who are selling their businesses and they're like, look, what we really want is for people to get that value, right? And to be bought in the way that entrepreneurs, the way we are. Like, there are entrepreneurs who feel like I'm a capitalist. I want my fellow workers to be capitalists. I want to figure out how to do this, but I don't want it to sell long term. So for these types of clients where I'm like, I do my co-op pitch and they're still like, you know, like, could we be a little bit more innovative and still keep some of the important governance and structural aspects that they want to see, and have stock-based compensation and value, like market-based compensation that has that wealth building aspect to it? It's completely possible. I haven't gone there yet with our clients, but you know, I mean, maybe.
Yeah, and I mean, I've never heard of this, so I'm not even going to answer your question. But Corey thinks worker co-ops are overstudied for their proportional to their impact in the world, which is probably true. But there are also a lot of really interesting and creative mechanisms locked up inside worker co-ops that we're not studying, which are meant to address exactly some of these questions. Is like co-ops are doing super interesting things. I know so in a co-op, your patronage dividend is distributed based on your economic participation in the co-op. And so in a worker co-op, that means how much you worked, how many hours you worked. So you get this sort of dividend at the end of the year based on your hours. At equal exchange, you get part of that in cash on your member account, and then part of it converts to a Class B share in the business, which is a way of sort of attaching some market value to that. And so I think it's worth studying the ways that co-ops themselves grapple with reconciling the perpetuity of the form and the member-centric nature of it with wanting to provide some market-based reward. And that's what we're here to figure out, is like, how do you actually use the economy to benefit the people who are working in it? So, yeah.
Maybe more. Yep. Yeah, go ahead. So if I can summarize just quickly, it's Essentially, yeah.
It's not. It's. You're getting like very difficult, like
Yeah.
things.
But if you recognize the loss at the startup phase in a co-op, you might be a lot more successful at modeling it out in the future. So, other questions? Marion Bison? Yeah. Yeah.
I'm wondering if you guys could comment, what's the most misunderstood aspect of each of these forms that you often hear from a business person?
Thank you for the simple question. What is the most simple most misunderstood concept of these different business entities? So with you.
Yeah, well, that's interesting. Kind of question really dovetails with another thought I was just having, which is to maybe sort of clarify that, ESOPs, the whole scheme as was drawn up in the law in this original ERISA legislation, was based on the idea that this was going to be, voluntary with existing companies, the existing ownership of a company, if they're going to choose to transfer ownership to the ESOP. I'd mentioned in my first remarks that the whole premise of these qualified retirement plans is that they are voluntary by the company, and so the tax laws make them attractive to encourage companies to make the choice to do that. And of course, the whole idea of setting up an ESOP is something that is done by the existing company leadership to make that choice. And therefore, the ESOP structure was designed to be as palatable as possible to sort of conventional business people, particularly back in the day in the 1970s. On the issue of worker control, for example, they thought that if we provided too much direct control to workers, even though they own the company, then conventional business managers are going to be put off by that, alarmed by that. So we won't require it. We won't prohibit it, but we won't require that in the ESOP form. And yet, I would say in terms of misperceptions, people out in the public, even in the business world that I talk to very often, are not clear about that, and they think that, if the employees had a financial stake in the company and had the opportunity to benefit financially, in my company if I owned it, I would have no problem with that at all. It's an obvious motivation, and I'd just like to see them motivated. That's fine. I'd be happy to see them have a financial interest. But if they also get to say in control, now I'm worried they're going to make stupid decisions and get rid of me, and people even use this term, it'll be the inmates running the asylum. And so it's funny how ESOPs can get a little bit of grief from both sides, in the sense that conventional business people are still concerned that somehow employees are going to be able to have too much authority, and then there are people maybe from the highly progressive, some of the cooperative-based organizations who feel like ESOPs are no good because they don't give the employees enough of a voice. So you sort of get it both ways. So that's still a misperception sometimes out there. And secondarily, the one would be, well, this employee ownership would be great. I'd love my employees to have my company, but I know there's no way my employees have the money to buy me out, so I have to forget this employee ownership idea. They don't realize that it's debt financed.
Yeah, we used to say when we were planning conferences, you knew you were doing something right if everyone was upset with the menu. So, similar to Mark, well, so I have two. One, I think with startups, there's a lot of magical thinking among people who are starting worker co-ops, that there's something about the form itself that will give them a market advantage, that will just be, it's sort of this catch-all for like good thing co-op. So, but it's a co-op, but it's still competing in a really cutthroat market. So you got to have a strategy, or it's going to sort of magically create higher wages because it's going to create better working conditions, which is documented, particularly in low-wage industries. So I think there is, as much as I want to get behind Mike's point that we need to have a rational kind of mechanism for people to understand the risk that they're taking, I also see that reason is not necessarily always motivating people. I think need is motivating people to do startups, but there's also some sort of magical thinking still going on about but it's a good thing, and therefore it's going to be an easy thing, or it's going to be automatically a better thing. And some of that magical thinking spills over into conversions where exiting business owners or even incoming employee owners sort of see a co-op as a sort of catch-all for solving problems, like participating in governance or having an ownership share itself creates an ownership culture, which it doesn't. What creates an ownership culture is a very intentional dedication to creating an ownership culture. Sitting in a meeting doesn't make you feel motivated and excited and participating. That's one of the things I was really struck by in the ESOP world early on, was the attention and intention that went to creating engaging employees and creating an ownership culture that we in the co-op world were not doing. We were like, but you come to the membership meeting and sit there for 3 hours every week, which is sort of the opposite in some ways of an attentive ownership culture. And then I guess one of the real fears that a lot of both selling owners and incoming employee owners have is about decision making, which I think is related to this question of ownership culture. They sort of fear that all co-ops operate on consensus, that everyone makes decisions about everything, that there's no specialization, that there isn't a role for management. And that's just wrong. I think it's wrong even in the smallest co-ops that may not have a manager or CEO position. They still do perform management functions, and those are specialized. It just looks a little different, but especially in the larger co-ops. There's traditional management structure in place. So, and you can choose when you're selling your business to your employees how much of that is, continuous, at least at first. So I think those are, there's just a sort of general kind of haze around the employee ownership, and particularly the worker co-op form that allows people to project both their rainbowiest hopes and their deepest fears about what that structure actually means, when in fact it's a much more pedestrian investment that you have to make in making it really work.
Yeah, one of mine is definitely just the distinction between having complete, the reinventing work and holacracy, a complete autonomy, the difference between a management that's accountable to a board, that's accountable to members, and the managerial aspects of democracy. And I think the democracy in management versus democracy in governance is certainly one that's just conflated a lot, and trying to unpack those. And then on the other side, I think the assumptions when it comes to workplace democracy, that democracy is inherently inefficient, is wrong. I think it's just wrong. I think democracy, one, we have to be more creative on the way that we structure democracy. In the political sphere, people innovate at the local level and at the state level, and it never not always. It's not always a structure that lives out its ideals, but people think about it and think innovatively about representative democracy versus direct democracy and budget, and we need to do the same thing in the economic sphere. We need to think about the different ways that democracy can manifest inside of our economic institutions to make them, to balance efficiency and voice, to balance efficiency and the fact that these are groups of humans coming together to accomplish something, and that the leaders of those organizations should be accountable to the people who they lead. We need to figure out mechanisms to make that actually efficient. I think that that there's just an assumption and an eye roll to having to be accountable to people, but it's really a critical part of our economy. I think of the future of our economy and what it should look like. So that misconception that there's something about working with other people and not just telling them what to do that's inefficient, that isn't true. If you practice at working with people, it gets more efficient, and I think in the end it's one of those things where the research will someday just bear out that we should work that way, because it's the way that humans should interact. That we see in other places, Google did all this research on their teams where it's when everybody gets the chance to talk in meetings and talk about the same amount, then the team makes better decisions. And they just did this empirical research and, you know, figuring that out. And it's like, at the end of the day, the research is going to show that, like, acting well towards each other and being accountable to each other and trusting each other is more efficient in the end. And we need to just figure out how, we just need to practice that better.
I just want to offer a last thought on the continuously evolving challenge that Camille sort of laid out about sort of decision-making and governance in our workplaces. I think it's one of these things that, you know, maybe a few generations from now will maybe make some progress, get it sorted out. It's a work in progress. But there's some real challenges, but I'm going to make 2 points. One is that I think the greatest part of maybe so-called decision-making that goes on in our business organizations, whether they're ESOP or cooperative or whatever, is not done through you know, sort of formal, you know, democratic processes of voting. They're just working stuff out in the workplace. You know, I got a bunch of people who their job is to operate these drill presses, and they're trying to figure out where to position them, how to work them out, and whether they need to get new ones. What the hell's the, you know, person in the marketing department have any say in that? The people in that group, they're figuring it out for themselves. They're not going to have a company-wide vote on this. They're just working things out, you know, as they go along. It's not a, you know, a formalized sort of voting structure. So 90% of decisions in companies are just that way. They're just sort of localized stuff, and it's really like Corey laid out, that everybody has a voice in the stuff that they're involved in, and that's how you get stuff done. The relatively small number of sort of big decisions about the company that affect the future of the whole organization will go to sort of a governing board, and then I think that really has to be done through representative democracy. I think at the end of the day, you know, the workers who own the business, it's their business, they're the owners, and the owners are ultimately entitled at the end of the day to have final say. But in terms of specifically decision-making, there's a very complicated issues that call for a lot of expertise. You know, I think of it in terms of who should be on a board of directors. You know, I think that the workers should be able to have the voting rights, should be able to elect their board. I think it's very different from saying that workers should be on a company board. I think it calls for completely different sets of expertise. It's almost like going back to my example of this little group where these machinists operate these drill presses, these computer-generated drill presses. They're really complex machinery. Person that have lots and lots of training. They've been doing it for several years. They're now artists with these incredibly complex machines and can just do this amazing stuff with their drill presses. And the CEO of the company comes down, who was an English major, and they got an MBA, as all of a sudden trying to start telling this drill press operator how to do the machine. You'd say, that's crazy. What does this big shot CEO think he's doing? He doesn't know anything about this stuff. He's not qualified to tell this person how to do the job. Well, conversely, the same thing works in the sense the CEO has a job, and there's a skill set that person has, and the drill press operator doesn't have that skill set. So I think of it in terms of a board of directors as being like a committee that you look to provide some expertise. Some committees are just representative, like if we go to elect people to Congress, then I don't care how great their qualifications are. If they don't agree with me politically, I'm not going to vote for them. But if I had like a family member who had, say, a really bad brain tumor and it was really questionable what could be operated on, and we decided to convene a panel of the greatest, you know, brain oncologist specialists to sort of look at this thing, I don't care what their views are politically or whatever, what they represent me. I just want the doctors who have the greatest expertise in this field to figure out, to make the best decision for this situation. So the question is, as a board of directors of a company, is it more like a political body that's just sort of representing constituents, or are you looking for a group of experts who are going to help make the best decisions for the company? I think it's not all one or the other, there's sort of a degree, but I think the needle points more toward the side of we're looking for experts who really have the judgment and experience to be able to make the best decisions for the company. So I think boards need to be expert people. They're not there to represent their colleagues, they're there to make the best decisions. So that's my 2 cents on governance of any worker-owned organization.
Thank you, Martin. With that, I think I should wrap up with a few words. I think we've covered greatly we're here giving context for the research that we're reviewing here at the Beister Symposium. And it's striking to me to see how much of a contrast there exists between these two business entities. And anyway, I think we've covered a lot of interesting material. I do need to recognize our partners at City Community Development for making this live stream and video possible. And thank you very much for joining the Institute for the Study of Employee Ownership and Profit Sharing and for this presentation.